Silver, who is front-running the 232 tariff decision. Silver is rising for reasons the market is not yet fully admitting publicly. Behind refinery bottlenecks, accumulation, and an overlooked policy deadline, a different framework may be forming. Section 232 executive order creates a mid-January policy window where silver could be designated tariffed, incentivizing accumulation before any tariff action. Recall earlier in the year, late last year, when silver was spiking on the COMEX futures while spot was nowhere in London, that was people front-running the tariff.
Vince Lanci is a veteran precious metals analyst, known for uncovering hidden liquidity flows, policy-driven price signals, and structural stress inside the global silver market. Silver may be front-running a Section 232 tariff decision the market hasn't fully priced. Beyond refinery bottlenecks, rising accumulation, and tight physical flows, a mid-January executive order window could allow silver to be designated for tariff treatment, incentivizing preemptive buying. This framework echoes late-year moves when COMEX futures spiked while London spot lagged, suggesting anticipatory positioning rather than organic demand. Political and economic realities previously stalled tariffs on inputs governments want to secure. If accumulation persists ahead of deadlines, silver's strength reflects risk management, not hype, as participants hedge potential trade outcomes. Now, we present the clips from Vince Lanci's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Silver is rising for reasons the market is not yet fully admitting publicly. Behind refinery bottlenecks, accumulation, and an overlooked policy deadline, a different framework may be forming. This piece examines why apparent abundance can coexist with higher prices and why January 2026 matters more than it looks. Section 232 executive order creates a mid-January policy window where silver could be designated tariffed, incentivizing accumulation before any tariff action. Recall earlier in the year, late last year, when silver was spiking on the COMEX futures while spot was nowhere in London, that was people front-running the tariff that never materialized, because it's economically not smart to tariff something you want to buy. But nevertheless, smart businesses like General Electric were buying their silver beforehand and getting it into the US. Now that materialized as a big nothing burger, and silver collapsed, lease rates came in, and the market decided that there weren't going to be tariffs. But now we're in a different vibe. There is even though it's up $2 a day, right? Even though it's up $2 a day, this is a slow, orderly rally. Price is transmitting supply-demand problems, not leases this time. And that's because, well, we have reasons why we think that's happening. But the moral of that story is that there is accumulation before a potential tariff event again, but it's not taking off. It's actually reasonably orderly. And that smells to us of smarter, more organized accumulation. So we ask, who is front-running the 232 tariff decision, which may or may not result in silver being tariffed? If you're asking why would they tariff silver if I keep saying that they have to buy it, well, you buy it, you get it in the borders, then you raise the tariff. So let's say silver's trading $50. You start buying it knowing you're going to tariff silver at a higher level after you get enough silver in. So what you do is, because you're the United States of America and your price transmission is a global effect, you buy all the silver you can, you get it inside your border, then you raise the tariff and you say the tariff is now $20 higher than the price. So we're not going to buy your silver. They're not going to sell silver for anything less than that tariff. We're not going to buy silver. And what that does is it makes everyone in the world who has silver pull their silver off the market because they're waiting for a higher price. This has happened before, and we've talked about this over the years with oil, how threats of tariffs make the market go to the tariffed price. And I think that based on how the market is moving and how the lease rates are not complying, that there's a very good chance someone is accumulating in a little bit more methodical, orderly fashion in anticipation of tariff risk. Who that could be, We don't know, but we do have an opinion that we share with everyone. So rising silver prices fit in with a broader context with this January deadline, and that's a new framework. Accumulate first, restrict access later, and it results in a kind of orderly policy managed upside.
Vince Lanci frames silver's recent strength through a policy-driven, not speculative, lens. Silver's steady rise may be signaling accumulation ahead of a potential Section 232 tariff decision, with a key policy window forming in mid-January. Unlike past episodes, such as late last year when COMEX futures spiked while London spot lagged and tariffs never materialized, this rally appears slow, orderly, and methodical. Price action today reflects real supply-demand stress rather than lease rate distortions. Smart industrial buyers previously moved silver into U.S. borders before tariff risk faded, leading to a sharp reversal. Now, the vibe is different. Rising prices alongside muted lease behavior suggest organized accumulation in anticipation of tariff risk. The strategic framework is familiar. Accumulate first, restrict access later. If silver is bought domestically before any designation, a future tariff could effectively reset global price expectations. In this context, silver's advance fits a broader policy-managed upside rather than speculative excess. Let's get back to the interview.
Look at what happened in China. They stopped. They're in the process of restricting their exports of silver. Now, below that, there's another version. It says, "Founders Silver, beware the Ides of January." That's the same written piece, but the mini pod, there's a mini pod attached to it, and it's a walkthrough of all the information that we combined to come up with that conclusion and one way to interpret it. The written part elaborates on the closing observations that silver continues to rally despite there being plenty of it available, seemingly warning of a deluge of selling in the near future. But there is one thing that does not make sense, and it centers on the Ides of January. We also touch on the fact that we believe, based on information and insight and precedent, that someone is going to be announcing a digital tokenized silver product. So I think metal's being pulled into the Middle East for that reason as well. Goldman puts out their 2026 gold and commodities outlook, and several important themes emerge from that outlook. Energy understandably attracts the most attention, and it may well deliver the cyclical upside many investors are looking for. The more durable signal, however, sits elsewhere. Now, before we get into the durable signal, gold remains the bank's highest conviction long. The rally accelerated in 2025 as falling U.S. interest rates drew ETF investors back into the market, increasing competition for physical bullion with central banks. American investors competing with global central banks. U.S. is accumulating gold through its people, just like China did. The analysts expect these two forces to persist through 2026. The global commodity outlook into 2026 is being shaped by two overlapping forces: an intensifying U.S.-China geopolitical and AI power race at the macro level, and large, uneven energy supply waves at the micro level. Together, these dynamics underpin the bank's core convictions across precious metals, industrial metals, energy, and power markets. Now, there is a piece of this that we think is very significant and very telling. The report's emphasis on the insurance value of commodities deserves closer scrutiny. They say, quote, "The insurance value of commodities in portfolios as a growing supply concentration of the U.S.-China competition and other geopolitical conflicts raises disruption risks." Now, translated into practical terms, this is the onshoring theme that we've heard about for years, moving from manufacturing into physical shortages. The legacy of just-in-time supply chains, a product of peak globalization, is giving way to a model centered on storage, redundancy, hoarding, and security of supply. Commodities are no longer treated as flow inputs alone, tied to whatever the dollar price is. They are increasingly treated as strategic assets. To wit, they want the gold. This shift matters because it changes the pricing logic of the entire complex. Let me put a picture up a graphic that they use in there. And it's not actually easy to figure out. It took me it took a half hour for me. Inventory. All right. So when security replaces efficiency, meaning we need to have it, you need to have the convenience. What you get is number one, you get backwardation, because backwardation is convenience spread, right? Contango is a carry spread. Convenience, I want it here, I can defer delivery later. So now we're in backwardation in silver again, and that's a convenience spread. Now, during a convenience spread or backwardation, what you're really looking at is people are willing to pay a price to have it handy. Now, as with all this as the organizing principle, inventories will eventually rise because people are hoarding it. Spare capacity shrinks and price sensitivity increases. Over the next 5 to 10 years, we believe, until meaningful new supply is brought online, this framework supports steadily higher commodity prices rather than short speculative spikes. In that environment, the precise choice of commodity becomes less important than having diversified exposure across the complex with selective overweights where conviction is highest. So let me go through this chart a little bit here. This is what I believe is going to eventually be the new commodity macroeconomic cycle. Okay, as commodities become tools of geopolitics, the first thing is you have the first version there, the first quadrant, top center, insulation. Prices go up. That insulation is a nice way of saying accumulation. That's hoarding. Prices go up as someone hoards, right? Then the price is now at a high enough point that you move to expansion. And in expansion, people start drilling for more, right? Prices drop during expansion. And then concentration. Concentration is where everyone has been buying it, but now it gets bid out of the hands of smaller players. So out of the smaller countries' hands and into the hands of, say, China and the US, which we're seeing now. Or in a micro fashion, out of the retail's hands as they sell their silver above $50 and into the deeper pocketed hands, which are not going to be selling it at any price for any time soon.
Lanci explains that recent strength in silver reflects a deeper structural shift rather than a speculative spike. China is in the process of restricting silver exports, while metal appears to be moving into the Middle East, potentially linked to an upcoming digital tokenized silver product. Despite visible availability, silver continues to rally, pointing to accumulation ahead of the eyes of January, a critical policy and market window. Lanci ties this behavior to a broader commodities framework echoed in Goldman Sachs's 2026 outlook, where geopolitical risk and supply security replace efficiency. As commodities become strategic assets, backwardation, hoarding, and concentration of ownership emerge, supporting higher and more durable prices across the commodity complex. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.